Basically, we're going to look at today how to introduce order flow to your trading. We've looked at a lot of different things that you could use in order flow in the past few sessions, and it would be overwhelming to try and implement all of that at once, and probably would be a mistake to do that as well. So we're going to look at how you can bring in order flow into your trading without taking on unnecessary risk and without negatively impacting your trading. Now, I'm going to apologize to a few people in advance because there's going to be a few people's stories mentioned here. I'm not going to mention names, but they're absolutely going to recognize themselves. So for those people, I do apologize in advance. This is well intentioned. It is for the greater good. Just thank you for giving me the example. Anyway, any change to your trading is going to carry risk. So before you start to make changes, it makes sense to manage and to mitigate those risks. And just throwing in order flow isn't going to work for you. But the reality is that that is exactly what most traders that come across order flow do. So we'll look at the risks, how you can implement order flow based on where you are right now with your trading so that you can make your own plan. Now we'll also look at the idea of having a short-term as well as longer term trading goals as an alternative to just having profitable as being a single destination in mind for order flow or for indeed your entire trading career. And we're also going to look a little bit more at gameplay and the consideration of trading in crowded versus uncrowded areas when using order flow, and of course to keep you all interested, because I know I'm going to bore you with some of the theory, we're going to look at some of the setups. Now, throughout the webinars that we've talked about so far, we've used the analogy of icing on the cake. Now, for many of you, the cake would be the ability to define a location to enter a trade, usually through some means other than the order flow itself. The icing is using order flow to confirm or refine that entry location. Now, order flow can be both the icing and the cake. It can be trade location and entry confirmation. And in fact, we did a webinar a few weeks ago on Top Step called Day Trading Without Charts, which was showing you one way to do that. So before you go adding order flow to your existing trading methods, you have to have an honest look at an honest conversation with yourself. Take a long, hard look at how well what you're doing now is actually working. Because if your current methods are not working for you at all, order flow is not going to fix them. So if you're currently trading off moon phases and horoscopes and it's not working, then bringing in the dome and times and sales is not going to remedy that. So don't take this the wrong way. I'm not actually trying to single somebody out here. I'm not calling anyone a dummy, but it's just the reality of our industry. There are a lot of bogus methods for sale out there, and there's a lot of stuff on internet trading forums that is also total nonsense. So with this being the first day of the rest of your trading career and a time when you're looking at potentially using order flow in your trading, it's actually a really good time to have an honest review about the methods that you currently use. So in short, do you actually have the cake? Now, the majority of retail traders don't even know if they have the cake or not. And it's only the minority of guys that have a decent historical trade history to look back and analyze objectively. Now, there's a lot of traders that switch methods every few weeks because nothing works. And the funny thing is, it's those guys that have probably stumbled across a number of things that would have worked if they'd treated trading as a skill to be developed rather than a problem with a solution. And this isn't just retail traders. So I know a trader who was a great guy. Well, he still is a great guy. He gave up his day job. He wrote a letter to a prop shop, which was just an amazing letter to a prop shop about how he really wanted to trade. And they gave him a position as an intern. And he spent 12 months as an intern in a prop shop, earning $800 a month in London, sitting in that prop shop, and adding in one ingredient after another, constantly changing what he did for a full year until he gave up and went back into paid employment. Now that guy watched other people come in after him and go live whilst he was on this perpetual quest. He was a really, really smart guy. And I think it's possible that was his downfall, that he was so smart. Maybe somebody that was less inquisitive just did what they were told. Maybe those were the guys to make it. Now, I don't know for sure because I don't know the guys that made it. But I suspect the kind of less inquisitive, maybe less intelligent is not a great way to do it. I'm sure those are the guys that are actually making it. So for those of you in this cycle, many of you have actually right now got more trading knowledge than most prop traders because you've spent so much time learning so many different techniques. So at this pivotal point, I'm going to ask people in that position to consider the following as a distinct possibility, and that is that there are people out there right now that actually know much less than you about trading, but that are making money on most days. They do not know any secrets because there are no secrets. And the fact that you think they know secrets and you keep looking for them is one of the things that's holding you back. So the point is, you're rarely going to know with 100% certainty that any individual trade is going to work. And order flow is not going to give you that 100% certainty. So if that's what you're looking for, order flow is not going to do it for you. It's going to tip the odds in your favor, okay? But it can't fix something that doesn't work. So you have to set your expectations accordingly. Now, performance tracking. I had a chat recently with a trader, and he'd actually been doing really well, but he was having a bad day. So I said to him, and of course, before I asked these questions, I already knew exactly what he was doing. But I asked him, how do you know it's a bad day? Which probably sounds like a dumb question. And the answer was, I lost money. So I said, okay, how much of a loss would be normal and how much would you actually consider bad? And then I said, which of your setups have you taken today? And what's the expectation in terms of win rate for each? And I asked what kind of day are we having and which of these methods should do well on that day. Because after all, it's only a bad day if you go outside of what you would normally expect to lose. And of course, you all know already that he couldn't answer these questions, and we all know why. Because journaling your trades is just something smart that trading educators say, and that nobody really does, right? Well, if you want to bring order flow into your trading, making a fundamental change to the way you trade, how can you do that without having a way to review the impact and the results of those changes, to know how well it's working? Are you just going to go by the profit and loss? And what if one aspect of order flow is working really well for you because it resonates with you, and another part of order flow isn't working so well? Is your P&L going to show that? And in the heat of the moment as you're trading, will you be able to track unemotionally your performance to figure out what's working well for you and what doesn't? Because I don't think you can in the heat of the moment. I think you can only go back at the end of the day or the end of the week and the end of the month and look back and see what works. So as a minimum, I would suggest that as you make these changes, you segment your trades into trade types or setups and you give each one a name. So for instance, trades that we've talked about in these webinars, a range scalp, a pre-breakout trade, and measured pullback. So each of those name setups should have some guidelines on how you should execute. So it's like a trading plan. Now you should also separate out that trade location portion, like for example double top, from the order flow portion, because that's what you're introducing now. So the order flow portion could be absorption at the top with large buyers trapped. So now you've got names for the icing and the cake. And when you trade, you should write down the trade type, the order flow signal, how far that trade moved your way, how far that trade moved against you, and how well you followed your plan. Now you can also log information about other things you watch, like the NICE tick, correlated instruments, liquidity, swing volume. But perhaps the most important thing you want to log is actually how well you followed your rules. So you could give yourself like a 1 to 5 rating, where 1 is I followed the rules and 5 is I shot from the hip. Now, once you start this logging, you would really need to give it 20 to 30 trading sessions before you review the results. And you shouldn't be making any changes at all to how you trade until you've actually got through this 20 to 30 trading sessions. And if you change anything in these 20 to 30 sessions, you're basically going to invalidate the results. Now, of course, if something is turning out to be a complete disaster, then you can drop that, obviously. But overall, you shouldn't be tweaking anything. Now, the trader I mentioned at the start of this slide that was having a bad day contacted me 2 days after he'd agreed to log his results. And he said, I'm going to add in footprint charts. I'm like, okay. I thought you were going to stop changing the way you trade. He says, yeah, but I'm not going to change the way I trade. I'm just adding footprint charts in for more information. And I said, well, that's pretty much a perfect description of changing the way you trade. And I swear, for some people, this is an absolute addiction to just keep changing. Anyway, after 20 or 30 sessions, you can take a look at the results, okay? And you might find that some of the setups are just useless. You might find that some of the setups are good when you follow your rules, but lousy when you deviate from your rules. You might find that looking for absorption works in one setup, but not for another. At that point, you're in a position to make an educated choice about any long-term changes. You could drop a setup. You could more closely follow your rules. You could only take trades on a certain order flow confirmation. You're making an informed decision. And the end goal is to know what works for you. And this knowledge is what is going to bring confidence. It's the confidence that this brings you of knowing how a setup should work that stops you from doing dumb things like moving your stops out of the way just in case. And this level of confidence is effectively the secret that a lot of people have been looking for and in this constant cycle of changes. So I'm not going to say any more about logging, but basically it is absolutely pointless implementing any changes, bringing an order flow without having a way to know if it's working for you. So logging is no fun, but it's effective, and it really is the only way I know that you could actually implement a change and know if it's working for you. Okay, so that's my lecture over. So let's say you had a long hard look at your trading and you came to the conclusion that trading off Rick Santelli's tie collar is not actually working for you and the order flow is unlikely to fix it. So I'd say if you're looking for a benchmark, is my trading working? I would say breaking even or breaking even and covering your costs. Then what you have is probably fairly close to being working. Now, I could be wrong, obviously, because I don't know every method. I don't know every trader. But I'd say anything less than breaking even or covering your costs, you really do have to think about just dumping it completely. I know it's kind of harsh. You might have been spending 5 years not making money and you're looking at all those skills and thinking, man, I can't throw that away. But if it's not making any money, why not just start again? Okay? So my advice, if you have no cake, is to do what the prop shops encourage their interns to do, and you trade much shorter term with small targets. Now, I post my pre-market prep on TopStep every day, and a lot of new traders try to emulate that whole method. In fact, I get lots of emails saying, can you send me your chart setup? Can you send me your template for your charts? Now, I've been watching the ES for absolutely years, so I've got a feel from the bigger picture, but also I've been doing that every morning for years, right? So that bigger picture feel takes a long time to develop. So guess what? I can give you my chart setup, but like that's something I've been working with every day. You're really not going to just be able to pick that up and do my pre-market prep every day. Now you could start doing your own and in like 3, 4, 5, 6 months be as good as me without a doubt. Could even take you 3 weeks if you're a lot smarter than me, which I'm sure many of you are. But it's a bigger picture feel, And there's no reason you can't actually start developing those skills right now, but realistically, that is not what's going to make you money in the next few months if you're not already making money. So I suggest that your short-term plan should be short-term trading. You start banking some profits with short-term trading, and you can still look at the long-term view as you develop as a trader. So making profit isn't necessarily your destination as a trader. It's just one step on the journey. You don't stop learning stuff just because you start to make money out of the markets. Now, for smaller targets, what do I mean like shorter trades, smaller targets? I'm talking about the typical pop that you'd get off an order flow setup. So a typical pop on the ES might be 4 ticks, for instance. Could be 10 ticks on crude. Obviously, as liquidity changes that we already talked about in the previous webinar, that's going to impact that kind of pop on a day-to-day basis. But basically, you get the idea. Now, retail traders, a lot of you, I'm sure, say, oh, 4 ticks. Ugh, I don't like small targets. And a lot of retail traders start out with the dream of turning $5,000 into $1 million, or even trading for a living off a $5,000 account. And that means they try to hit home runs every trade because they effectively need big wins to make enough money to live off 1 or 2 lot positions. So it's not unusual for a trader to work backwards from a need to earn like $500 a day to figuring that actually means they need 10 points a day from trading their 1 lot on the ES, which is basically 10% a day on their $5,000 account. And of course, that is what ruins those people. So if somebody said to you, look, just trade well, don't worry about the returns, build up a track record in the next 12 months, and if you succeed, I'll give you a couple of $1 million to trade. Okay, if somebody said that to you, you'd be able to take a much lower risk approach. You'd be able to focus on taking a few good trades a day with small targets. You could be selective and not be under any pressure to pick the top or the bottom of the market and try and get a 10-point run on the ES. In short, you would actually be more likely to succeed. And the fact is, the money is out there, and that's what organisations like TopStep are about at the end of the day. When if you talk to a lot of prop traders, successful prop traders, when they lose the prop shop, what is it they want to trade? They want to trade other people's money. They don't want to trade their own account. So with short-term trading, you're going to be taking shorter-term trades. You're going to need to be a lot more aggressive about cutting those trades, and you're going to be looking for levels to lean on, and also for something we call gameplay, which we're going to talk about later. And you're going to take shorter-term trades. Now, as well as the setups we've discussed in the Jigsaw webinars, there is a really good book out there called it's the No BS Day Trading website, and I'm giving that a plug here. It goes through some very specific order flow setups that I don't cover in my webinars because basically I know the author and Johnny's a good guy. But as a short-term trader, you're not trying to assess where the overall market is headed at a macro level. But you still will need to be aware of major highs and lows and key levels, as there are going to be activity changes at those levels, and you might actually want to consider avoid trading into them. Now, as a short-term trader, I guess the downfall is, if you're looking at small trades, is you do need a higher level of order flow reading skill than somebody who's just using it as icing on the cake. But you will be getting more setups per day, and more trades per day means you experience more trades in a shorter period of time. Okay, and what you aren't doing as a short-term trader, you are not just switching on the PC and just hitting trades every couple of minutes, and it's not in my experience anyway. So if this is you and you need to use order flow as cake and icing, I would recommend you go and look at John's book, No BS Day Trading. I recommend you go back to our webinar, Day Trading Without Charts, and have a look at those styles of trading and seriously consider looking at that. Now, for those of you with cake, which means you have something that is working reasonably well, then order flow is just going to become your icing. Now, most people look at order flow as something that primarily concerns entering a trade, which is basically refining a trade entry or rejecting a trade. Now, I do agree with this. This is probably one of the best uses of order flow. But I would also say there is a very good argument to starting off using order flow to manage your trades after entry. So let me just say that again. Your starting point with order flow, you don't have to focus on the entry. You could use order flow, start using order flow to focus on managing the trade right after entry. So using order flow in the first few minutes of a trade until you have some breathing room in a trade. Now I'm going to show you something from the Jigsaw platform. You know, I'm not trying to plug the platform here. I've already told you that all order flow tools are effectively a variation on a theme. But let me just bring these across. So what I've got here on the right is a time in sales, and what I've got here is just a meter. The red is showing me sell market orders, the blue is showing me buy market orders. Okay, so let's just reset that as I talk. So if you go long, okay, and you see 2,000 sell market orders and 600 buy market orders, and you see price moving down after your entry and you're long, the chances are you're probably going to get stopped out. Okay. Now what we can see here, obviously, if I just entered a trade, it's early days. I've got 388, 293. We can slowly see, I can see some buyers, some sellers coming in, 64.75. So let's just watch that run. If you go long and you see 2,000 buy market orders and 600 sell market orders after you enter and price is moving up, you're probably okay. Also, if you go along and you see 2,000 sell market orders, 600 buy market orders, but price doesn't tick up, you're probably okay as well because sellers are getting trapped. But right now, if you're in a long trade, you know, you'd enter the long as, you know, just before reset that, this absolutely isn't what you want to see. You do not want to see lots of selling and price progressing down after you go long. And that in effect is the crux of using order flow after you enter. That's all it is. And it's just about managing the first few minutes of a trade. And what you're trying to do is you're actually trying to prevent yourself from getting stopped out. Because if you see this flood of orders coming in against you, the trade's probably not going to go your way. Now, price can move against you without the order flow moving against you. So you might enter long and price move against you, but the order flow in the move is weak. So price is moving down, but there's no momentum behind it. Now, in that situation, there really isn't a need to exit the trade. So your stop loss doesn't become a price you exit a trade just because you get there. Okay, you might actually work an exit before you reach your stop. Price might actually go your way with order flow on your side, and then suddenly you see thousands and thousands and thousands of sell market orders coming in against you, and you decide to get out of the trade. Now, you might be getting out of the trade at that point before your stop's being hit, or you might actually still be in profit. Okay? Now, in some cases, you might widen the stop because the order flow against you is weak, but you need to be cautious with that. Generally, what we're talking about is getting yourself some wiggle room in a trade in the first few minutes after entry. So getting yourself some breathing room in a trade, and if you can't get that breathing room, if it just moves a few ticks your way and the order flow comes in against you, then you get out of the trade. So this is the first potential use of order flow, and it is actually easier to use order flow to do this than it is to enter a trade. Okay. Now, you will be able to reduce the size of your stops when you start to use order flow. But compared to order flow as the cake and icing, so the kind of scalping methods, using order flow for a 4-tick trade, you're still going to need to have some wiggle room in your trades. And just a couple of days ago, I had a trader tell me his plan was to fade prior highs on the ES with confirmation on the order flow with a 3-tick stop and a 10-point target. So his expectancy that he'd be able to get a 50% win rate with a 3-tick stop and a 10-point target. Now, whilst nothing is impossible, that is certainly improbable. So for sure, you're going to catch to the tick entries at times, and then you will see the market making a good run after your entry, but to expect to hit trades like that every day to get a 10-point run off a 3-tick stop, it's very, very tough. And the other thing to consider with these tight stops is if you enter a market order right now, we're offered 63.75. Let me bring across the dome, it's easier. Okay, so if I was to enter a market order now to buy at 64.25, the bid is actually 64. So if I use a 3-tick stop at this point, my stop's going to be at 63.50. What that actually means is I only need the price to tick down 2 prices. I only need the bid to drop 2 prices to stop me out. Okay, so when you're looking at a 3-tick stop, if you're entering with a market order, what you've actually got is a 2-tick stop. So as you plan to bring order flow into your trading, you've got to keep things in perspective. If you are going for longer term trades, for me, I like to scale out. So I will scale out at 4 ticks. But I will actually, if a trade goes my way and I get my first scale out, I will let that trade move against me. Because the fact is the scale out's actually given me more breathing room into the trade. So unlike the scalping, the shorter term trading, stopping out too aggressively when you're taking longer term day trades is going to see you close out a lot of good trades early. And entries in what I'd call crowded areas and gamed areas that we're going to look at later are going to need more wiggle room. So we'll talk about that slightly later. So the big change when you look at order flow to confirm levels is effectively, if you're using order flow as a confirmation tool, then basically what you're doing is you're going to shift from trading a specific price to trading areas. So let's say in this case here, your analysis said, okay, this is a trading range, and your plan was to trade from the outside back in. So from a pure chart perspective, you'd be looking at shorting 84.25 and going long 79.50. Now, when you introduce the order flow, you have to change from looking at that as a level to looking at it as a zone. So you're expecting the market to turn somewhere in this area, and you don't enter until you see absorption on the bid, because it's a low, the sellers fading away, or buyers jumping in force. And we're going to introduce a number 4 that we didn't talk about last time. And the other thing you're going to look for is gameplay. Now, if you don't see this, or you see it but you remain unconvinced, then you don't take the trade. Okay? So if you see aggressive order flow going down into that level with price progression down, you don't take the trade. Now, of course, you can just take the trade at the level anyway and see if the order flow comes in on your side with that post-entry analysis. Because it is much easier to read if the order flow is on your side when you're in a trade than to see if the market is turning around prior to entry. And that will go double for any major level that everybody is looking at. Let's just consider major and minor levels, because what is a major level and a minor level? We did discuss in a previous webinar, major reversals are areas that lots and lots of traders are looking to take trades. Okay, so major swing highs, lows, high of the day, yesterday's high, areas like that. Minor reversals, like secondary pullbacks or small developing trading ranges, tend to be created intraday, sort of on the fly. So if your method of using, or if your method of analyzing major levels is correct, then you should generally see a reaction at that level. Now, you might not see a reaction on the chart, okay, depending on what chart you're looking at, but you will see a reaction in the order flow. And you should see changes in the market depth going into that level. So as you move up to resistance, you will see large offers above. Now, large offers above and a kind of short-term reaction at that level absolutely does not guarantee it's going to stop and turn around. It just means it's a level that there's lots of people looking at. Now, obviously, on occasion, you will see price go straight through a major level without stopping, but that actually isn't the norm. the normal thing for you to see at a major level is some sort of reaction. Okay, not necessarily the full reversal you're expecting, but some sort of reaction. And at these major levels, the reason you get a reaction is because there are a lot more people jostling for position, and there's a lot more gameplay as large traders nudge the market around, trying to push people out of position. So I consider these major reversals, what I like to call them, is crowded areas. It's a crowded area to trade. And some people, some very, very large players, all they do is they look to push people around in those places. Now, if we consider a pullback, a retrace to a step in the intraday profile, that was developed intraday, a minor reversal, that I'd consider an uncrowded area where there's not so many people jostling for position, and there's also not so much opportunity for somebody who's nudging the market around to take a lot of people out. So when you look in at major and minor levels, you have to consider looking for more confirmation off the order flow to trade a major level than a minor level. So as an example, markets moving up, okay, you might see the price pull back 8 ticks on the ES, and suddenly nobody wants to sell anymore. Okay, we just go down to a price, a few contracts trade there, we go a couple of ticks up, then we come back down to the price again. Once again, a few contracts or no contracts trade. That would be what we call sellers fading. And that seller fade is a fairly weak confirmation on its own. Okay, it is icing on the cake, no doubt, but it's a weak icing on the cake. But in a pullback to a step in the profile or a measured move where every pullback in the morning has been 8 ticks and you're already 8 ticks back, your risk is well defined. That seller fade is more than enough for me to enter a trade, with my defined risk parameters. On the other hand, if the market was moving down, the market's just moved down 8 points, and you're trying to catch the end of the down trade, seeing that seller fade on its own is something I would never trade personally. So it's the same order flow signal, but you're in an area where there's a lot more people looking to trade, and for me, I just wouldn't be happy trading that. So the market's going to wiggle around anyway. So we all know that as the market moves down, it wiggles around and we get occasional pauses. So differentiating between just a regular pause in a move down in the action and sellers laying off that price for good is very tough, just seeing them come down and not trade the price a couple of times. Okay, so when overall momentum is to the downside, you're going to need more confirmation off the order flow to take a shot at a long. Now, I'd prefer, personally, to see some size coming on the buy side and give up a few ticks in price for the additional confirmation in a long trade if it's a major level. So a major reversal or a crowded area is going to require more confirmation. Now, we discussed in the first webinar about how you can use longer term order flow to set bias. So footprints, cumulative delta, delta bars are all longer term order flows you can use to create a bias. So don't just feel you need to stick to the DOM and the time and sales as you implement the order flow. Okay, there's a whole bunch of tools out there. We know, and they give us, we talked in the first webinar, they give us all a different perspective. Now also be aware that days don't always play out the same way. So the level, if you like, the highest level above all this, above your day trading is, how's this day playing out? And volume helps as well, because about 1 in 10 days on the market I trade the ES, we get a one-way day. So often that's on the back of a news announcement or some news event. And those days are quite often accompanied with high volume. So on a one-way day like that, you often don't get much in terms of retracement. You generally do get small ranges forming on the volume profile, but they're often like 2 or 3 ticks. So you're not really getting the 8 tick pullback that kind of give you a bit of confidence to enter. So there's not much of a retracement, and the order flow is different. You do still get the micro ranges, but on days like that, sometimes you just have to grit your teeth, get in and watch the order flow after you enter to make sure you're not getting on the top. So as well as, what are the order flow signals, major and minor levels, keep an eye on what is the day doing. Because if it's a one-way day, you really shouldn't be looking for a major reversal. So be aware of the type of day you're having. And it's the same when the market slows down and you go into a tight range. So kind of the opposite of a one-way day. You won't get the pullbacks. Okay, so as we go into a tight day, like the 5-6 point days, you get very tight days. You don't get the pullbacks because of that tighter range. So fading the extremes, taking what on another day might be a major reversal, actually becomes a safer option on those days. So don't just be focused so much on the order flow and always taking the same order flow signal without taking a step back and saying, okay, what kind of day are we having? Is it a wide range day? Are we just shooting in one direction? Is it a normal 10 up, 10 down, 10 up day? Is it a really narrow range day? Now, getting stopped, this is always everybody's favorite topic. One of the benefits of using order flow is filtering out bad trades. Okay, so you don't get into trades where you just get stopped out anyway. Now, a fairly easy way to do this, it's not really a trick. Okay, but it's one of the things as you start using order flow, it's one of the easiest things to do. Okay, and it's something in the pit they used to call getting the edge. Okay, so fairly easy thing to do. Let's say I wanted to go long here. Is you wait for the offer or the ceiling above you to start breaking down before you go long. Okay, and we saw there that the offer went down to 78 and then we ticked up. Okay, so let's say you were at a level and it came down and you wanted to go long. Okay, so let's say at that point the offer was 1500. Okay, and the offer's 1500, so 1500 by market orders have got to hit the offer before it ticks up. So as there's 1500 there, you don't enter the market. You wait for that 1500 to come down to 1000, 800, 600, 500. And when it gets to 500, 400, 300, whatever it is for your market, then you hit into it with a buy market order. Now, obviously, if you're doing that, if you're waiting for this level to break here, you don't want these levels below you to be breaking too. Okay, so you have to kind of keep your eye on these things. And with this technique, you do need a fairly thick market. This isn't something you can do on crude. Works on the ES a lot of the time, but right now on the ES it's fairly thin. We are in lunchtime, so it would be a bit tougher. So like right now, I wouldn't be able to buy. I mean, my bid's 200, my offer's 347. Waiting for this offer to break. If I wanted to buy, I'd be waiting for this offer to come down, probably to 200. Let's just see what it does. There's no way you can tell whether it's going to go up and down. Okay, so somebody just whacked into it. So that's one of the downsides when you're looking at a day where the liquidity is fairly low. Somebody just can whack into it. But what will happen is quite often you're sitting there waiting for the offer to break, waiting to buy into the offer. Okay. And you'll sit there and waiting for the offer to break, waiting for the offer to break, waiting for the offer to break, and then the market ticks down. Okay, so it's okay. I'm still interested. So wait for the offer to break. Wait for the offer to break. Wait for the offer to break. Market ticks down again. Okay, so I'll go to the next level. Wait for the offer to break. Wait for the offer to break. Market ticks down, and suddenly you're sitting where you would have been stopped out if you just entered a trade long. Okay, so this is what they call in the pit getting the edge, and getting the edge is effectively trying to hit into a level right before it ticks up. Okay, so if you buy 65.25 just before the offer breaks, the market will then tick up, suddenly on a break even trade. Okay, but the real benefit is in sitting there waiting for an opportunity to buy and watching the market slowly tick down against you to the point you would have entered point you would have been stopped out. Okay, but still, order flow isn't just about entry, as we talked about earlier. There is an argument for starting off using order flow just to decide whether to stay in a trade or not. And just because when you have a position on, it becomes much easier to interpret the order flow from the perspective of that position being good or not. And it's not what we're going to be doing today, but look, we'll just show you if the market will cooperate. Let's just put a sim trade on. Okay. and just show. So just imagine now if you were long, okay? So what we can see, we'll just move that across here. Always like that to the right. Just give this a couple of minutes. So I'm long, and what can I see? I'm long. Price has ticked against me two prices. This meter here is showing me the buyers against sells. There's slightly more sellers than buyers, but actually it's quite equal at this point. So if I was looking to get stopped, if I was looking at a stop right now, we do have 2,000 contracts trading here. Okay, now look at that. Okay, 1,500 contracts against me, 500 buys. So 1,500 sells, 500 buys. How would you feel right now about being in that trade? How would you feel about this low of the day holding? Okay, so you wouldn't, if you had an 8-tick stop on that, or a 6, 7, 8-tick stop, you wouldn't really want to stay in that trade. There's nothing that's telling you that this 1865 price is a good price and the market's about to turn around. Okay, there's another trade down here that says, okay, the market's just poked through the low, potentially that's a head fake and it's going to go back up, but that's a completely separate trade. And if you kind of get into that habit of like getting in a buy here and then looking, oh well, maybe this isn't a bad place to buy, and maybe this isn't a bad place to buy, and maybe this isn't a bad place to buy, well, we all know what happens there. Now if you're confirming trades with order flow, you shouldn't get stopped out very often, because you should be trying to get out of the trade when the order flow goes against us. So you should still be having losing trades, absolutely. But if your standard stop is 6 ticks, there really isn't a reason to get out just because that specific price is traded one time. And let's just look at that dome again. Okay. So let's also say we're long and price is moving against us, which it is. And let's just say we had a stop loss at 62.50. Okay, so I've got a stop loss at 62.50. So if we tick down to that price right now, we need 1,100 contracts to trade before it gets through 62.50 down to 62.25. Okay, so a traditional stop loss order at 62.50 is going to trigger when we come down to 62.50 and one contract trades. So we've just talked about waiting for the offer to break before I go long. So the inverse of that is not stopping out just because one contract trades at my level. Okay, so let's pick another example. Let's pick this 1,600. Oh, that's going to disappear. Okay, so let's look at 62. 1,000 contracts trade. Okay, so what do you do when it comes down to 62? Okay, you keep your finger on the trigger. The price come down to 62. You see 1-2 contracts trade. You still see 1,000 bid at that price. 1-2 contracts trade. You don't need to get out. Okay, you don't need to exit that trade. 100, 200 contracts trade. I still see 1,000 there. I don't need to get out. When I see that 1,000 go 800, 600, 500, 400, then you exit. Okay, so again, it's using the depth and it's using the contracts that trade at that price to figure out, are they hitting this price aggressively enough that it looks like it's going to break through. Now, there are some caveats with that. Okay, first of all, if your price is in an area where there's lots of stops, it is going to just blow through it, right? It is going to blow through it because you're going to get to that price. Other people's stops will trigger. There won't be time to assess whether that price is holding. The other thing is, if it's not in a price where there's lots of other people's stops, this exercise of saying, right, I'm not going to put my stop loss order in at 62. I'm going to wait for 62, see if it holds or not. Of course, occasionally, you're going to get stopped out. You're going to get through here. So what I would recommend is actually, if you're saying, right, I'm going to see if 62 holds, I'm then going to sit here watching this level, and I keep a stop order 1 or 2 ticks below, because basically what I'm going to do is I'm going to watch that level. I know sometimes somebody's just going to go and hit that with 1,000 and it's going to go straight through. So sometimes you're going to lose an extra tick when you're doing this, but most of the time you're going to be okay. And a lot of the time you'll actually come down to where your stop is, you'll see a bunch of contracts trade, it holds, and then it goes back up and it effectively saves your trade. Okay, so again, that's a fairly easy thing to implement, but you've got to be the type of character that doesn't see it then tick through that and do the same thing at the next level down, the next level down, the next level down, the next level down. Okay, but again, waiting for levels to break. It can work on your entry price. It can also work on your exit price. But obviously, on your stops, you will occasionally lose more because you're doing that, because somebody will just whack it. Okay, so that's effectively using order flow potentially on your stops, not just stopping out because you hit the price, stopping out because they trade into the price. Now, icebergs are pretty much in vogue, and we didn't really spend much time talking about icebergs in the webinars yet. They are very much in vogue in the retail trading world, and I think like to say I've done my bit in making them in vogue. There's a lot of mystique surrounding iceberg orders, but really they are simple. So an iceberg order is simply a limit order that gets refreshed over time. And the simple reason is, if you wanted to buy 10,000 contracts and you just put a bid up for 10,000 contracts, everybody else that sees that is going to buy in front of you. They're going to front run your order. So you put in a bid for 1,000 and you keep adding more contracts as people sell to you. Now, all it means when you see an iceberg is it means that somebody wants to buy without letting other traders know. They actually want to get filled. But obviously, anybody who's watching the order flow is going to notice that. Okay, you can't not notice order flow. If you're watching orders hitting to a price, you can't not notice it's an iceberg, right? So it can mean that the bidder wants to absorb some the selling, hold the market, and push it back up. But it is just as likely to mean that it's one half of a statistical arbitrage trade, where the other half of the trade is a basket of stocks, and the trader has absolutely no directional bias and doesn't care at all what the market does, or what that individual market does after he enters that trade. So for me, I've got a few simple guidelines for iceberg orders. Okay, so the first thing, if you're looking at an iceberg order, the volume has to be significant, the actual volume traded. So if you're on average trading 1,000 contracts per level, then you want to see 2,000, 3,000, 4,000 contracts absorbed in the iceberg order. So if you're trading 1,000 a level and somebody puts an iceberg order in for 200 contracts and they refresh to 200, doesn't mean anything, right? Now, in a move up, like a 7, 8, 9 point move up, a typical move in a market, an iceberg on the offer side, so an iceberg on the ceiling, is not usually going to cause a reversal down. So not unless it's at a price you're already expecting a reversal to occur. So the trade location coincides with the iceberg. So fading all icebergs is not a good strategy. There are icebergs that are going to appear out of nowhere in a location that you're not looking at, in the path of a move, and you think that's going to stop the move. Then it moves through 3 or 4 ticks, and you see the same thing again. And I did this. There's a guy I know called Mac, and he used to be a runner for Peter Stiedelmeier. And he was at my house one day. I said, Matt, what's going on? There's this guy, man. He's just nuts. Because the market moves up 4 ticks, and he steps up with an iceberg and absorbs 3,000 contracts. And it moves up 4 ticks more. He does the same thing again. Moves up 4 ticks more. It does the same again. Because this guy's going to run out of money at some point. And it was Matt that told me, no, Pete, that's actually stat arb strategies. That is actually just half the trade. Okay? So it's not an idiot with a $50 million account. It is stat arb. So basically, you're going to see market move up, iceberg in the way, moves through it, iceberg in the way, moves through it, iceberg in the way. So you can't use an iceberg out of in the middle of nowhere to short a major move. Okay. Now, on the other hand, in a move up, when you see an iceberg on the bid, so you're moving up overall, you're pulling back, you see an iceberg on the bid behind you. Okay. That very often stops a pullback in its tracks. Okay, so icebergs in a pullback, yes. Icebergs to stop a trend, no, absolutely not. You'll get run over too many times. Now, the other thing is icebergs have to be ignored in choppy markets. You're going to see a ton of icebergs all over the place, and they're not particularly significant when the market's choppy. So what I mean, when you see the ES go into like 4 or 5 point range, you're going to see lots and lots of icebergs in the middle, and you've just got to ignore them. The extremes of the range, absolutely. They are confirmation of the range holding, but in the middle, they're insignificant. Now, if you go to a thinner market like the crude, you're going to see icebergs occur over a series of prices. You won't see an iceberg at one price turning it around. You'll see a series of icebergs. It'll go up and then see bum, 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 bum. an iceberg, and you'll see there's actually, you'll go and you'll see this thick area where a lot of contracts trade. That is what you need to look for on the crude and thinner markets, not just an iceberg at one price. So that's icebergs. Won't stop a trend, will stop a pullback effectively. Now, we did speak earlier about gameplay, which is another word for manipulation, or the art of getting people to sell to you so that you can buy, or getting people to buy from you so you can sell. It's also the art of putting other traders offside. So this is something, gameplay, that is more likely to occur in a crowded area where there's lots of people to push out of position. So it's not going to happen in a pullback because there's just not enough fresh meat there. There's not enough people to take out. So you really do need to consider a crowded and an uncrowded area differently. So one of the most common games or plays is the flip. A lot of people will have heard of the flipper. It's not a dolphin movie. It's a guy called Paul Rotter who's kind of famous for this. Some markets you can get your hands slapped for this. I know in the FTSE futures, I know a trader who got fined for this. On the ES, on US markets, on Eurex, seems to be fairly normal practice. Now, in the example we're going to show you, we've got a flip close to the pit session high. So we're going to look over in this picture on the left. My prices here in this picture for the whole the Globex Plus pit session. This was a pit session high, 6625. And as you get to the pit session high, it's an area where people are going to fade the market. Now, the first part of a flip is accumulation. Okay, so again, I said gameplay is the art of getting somebody to sell so you can buy, or getting somebody to buy so you can sell. So you're going to accumulate some contracts. Now, when these guys try and do this, it's not like everybody's stupid, right? Like, people know that this stuff goes on. So sometimes they're going to fall for it and sometimes they're not. So sometimes you're going to see an attempt to gameplay other traders, but they just don't fall for it. So if you're actually trading off the back of this, you actually don't just want to see them try to do it. You actually want to see them get other people to do what they want. Okay? So the accumulation stage is where the flipper, in this case, wants other guys to sell so that he can buy, or she. So overall, we've got a narrow day. There's low volume. It's not a day which is moving one way and high volume. Those aren't good conditions for gameplay. So if the market is just roaring one way, nobody can just sit in front of that and nudge it around. So if we think about it, we've just come off the high. We're 1, 2, 3, 4 ticks off the high. Market looks weak. People have faded as coming off that high. Expectation is we're probably going to go 6250, probably going to go to the other end of the range. Okay. If we look over on this side, we can see the offers in the range of 2,000 to 2,900. If we look at the bids, 900 is the lowest, 1,700 seems to be about average. So the bids, you can say definitely the bids are a lot smaller than the offers. So again, from a depth perspective, absolutely looks like a weak market. Looks like it's going down. Okay. So we've got the bids. We've got the bids lower than the offers. We've got the fact that the market's come off the high. And we've got the fact we know that people fade the highs. So overall, looks good for a move down. Now, if we look at this 1365.25 here, we can see 2,100 contracts traded. Offers are still stacked. But at this point, if you're a seller, you're suddenly going to be a bit nervous. Okay? So this selling here at 65.25 isn't moving the market down. Okay, so yeah, sure, if you're watching this now, you can think, yeah, those guys are getting trapped. Plus also, the sellers are thinking that as well. Now, if we go over to the right, this is a few minutes later, we've actually moved down another tick. So the fact we've moved down another tick past that area, that sticky area, is going to give the sellers a warm feeling about their position. So maybe they thought, oh man, I was trapped then, but now it's good. So we can see 20,000 contracts here hit into 65.25. In the previous slide, it was 16,000. So we had 2,000 there, plus another 4,000. So it's like 6,000 contracts sold into that level. Okay, sellers got a price move down, probably feel they're okay. And then we can see, if we look at the next level down, 65, we previously had 12,000 contracts. Now we've got 15,000 contracts. So we can see another 3,500 contracts traded in 1365. So it's going down. The market's kind of being let down, but on each step, they're absorbing contracts. And again, look at the offers. 2,600, 2,200. Look at the bids. 1,600, 1,800. Okay. So yeah, it's moving down. Yeah, I've got really ridiculous offers following the market down. Yeah, looks like it's going to go down. But you've got to say to yourself, when you see this, are the sell market orders really consuming the liquidity there? I mean, we tick down, but with that kind of volume, and you have to know your market and know your volume at each level for a market, you would expect much more of a move down with that much selling. So the formula for a short to long flip, fairly simple. You reverse off a range high, a place where sellers are likely to step in. You see the offers are stacked. So we see the offers are stacked. You look on the other side to see if you've got sign of absorption, if you've got icebergs. If people don't sell into those bids, into those icebergs, just means they aren't falling for it. If they don't fall for it, flipper's going to give up. You have no directional bias. You watch for sellers to come in, as we see here. Sellers come in and get trapped. Now, of course, just because you know there's a big guy there trying to gameplay other traders doesn't mean he's going to win. He could get run over. They could keep selling and run through it. Okay? But basically, you watch that, and then what you're going to see, these offers will disappear. The bids are going to grow and firm up, and you'll see a load of buy market orders come into the market, and then it's going to shoot up. So let's just have a look, in this case, what happened. We can see that the market drops as low as 64.75. If we look at the volume, you can look at the slides later. Looking at the cumulative delta here, we can see the delta dropped around 10,000 contracts with really no price move down. And we can also see these little blue triangles, which are iceberg markers. Now, looking at the dome, what do we see? Okay, we can see all of the offers have disappeared. All of those big offers, they've just gone. Now, we look on the bid side, the bids, we've actually got some decent bids now following the move up 2,200. And the thing about the bids, if you had like 3,000, all of these levels, 4 or 5 levels, that isn't what you want to see behind you on a move up. It's because it's fake. But if you see decent bids following a move up, that is real support. If you see like 1 or 2 decent bids, not obviously fake bids, moving up behind the market, that is good support. Now, this 2,900 contracts trading at 66.25, that could well be the flipper X in the last miss position. Now, when they do this, they're not going for a 10-point trade. Okay, they're actually just trying to stop people out. They're trying to get the people that reversed off this high out of position, and it almost seems an insignificant. It almost seems like an insignificant move. Okay, but if we say a modest estimate, this guy took on 5,000 contracts, and he had an average of a 4 ticks gain on those 5,000 contracts. You'd actually be looking at a profit of $250,000 for this flip. And that's 20 minutes work. So for me, I'm not a huge fan of joining flips. So when I see this going on, I don't join it. And I don't join it for the simple reason is I'm actually relying on that guy to be successful, which kind of seems like I don't know, it doesn't fit well with me. So I'm not comfortable in trading it. I like to fade the ranges. So I'm actually one of the guys that this guy is trying to stop out. Okay, so for me, the benefit for me in seeing somebody trying to flip the market is I want to know if somebody's actually trying to stop me out. Okay, so that's the flip. Happens a lot. You're going to see that a lot. So the last thing we're going to look at is stop runs. Now, I'm going to just give you an analogy for stops because there is a they're out to get me aspect to stops. Okay. And it is true because people do try and stop you out. But I'm going to actually try and relay my mental image of what a stop is and where stops build up. So let's say you've got 100 iPhones for sale and the market price for an iPhone is $400. Now the people in the house next to you, they say, yeah, I'm going to give you, I'll give you 400 for the iPhones. But there's some other guys a few miles down the road that say, I'm going to give you 500. So what do? You take a drive and you pocket the extra $100. And that's exactly what the market is doing when there's a stop run. And it's one of the most natural things in the world, right? Why wouldn't you go somewhere else to get more money? Okay, so there's a lot said about all these evil guys and stop runs, but why would it take you to be evil to want to buy something at a low price or sell something at a high price? So the simple fact is, nobody can see your stop order, right? Or nobody that matters can see your stop order. But it is presumed where they are, okay? Buy stops above us. So when somebody stops out with a buy stop above the market, it means there's a buyer up there that's willing to buy something higher than current price, right? So he's the buyer above you that's willing to buy the iPhone for $500, okay? So if you're a seller and you know there's a guy up there that's willing to buy for $500, you have a disincentive to sell at $400. Just like you would, you've got a disincentive if there's a buyer up there in the market, and there's potentially a lot of buyers up there in the market that are going to pay high prices. Sellers have got a disincentive to sell at these prices because they know buyers up there that are willing to pay more. So that's what a stop run is effectively taking advantage of. A group of people huddled in an area that are willing to buy at higher prices or sell at lower prices. Okay? And if you understand that, you can understand it's going to demotivate people. Buyers at high prices is going to demotivate anybody from selling at low prices. So don't doubt that there's people that push price around on purpose. But also remember, this is a marketplace. And if people are willing to buy at high prices, then you've got to expect them to take you up on that offer. Okay? So if you're a seller, you're going to be less inclined to sell at a lower price because you know there's buyers up there. So it follows then that the more crowded an area is with stops, the more sellers, so buy stops for instance, the more disincentivized the sellers are going to be, and the more likely you'll take a peek up there. So don't think somebody's sniffing out your stop order, because most of you aren't really big enough to even be important. So if your 3-lot stop order is 4 ticks away on the ES, there could be 5,000 contracts between the current prices and your 3-lot stop order. And nobody's going to buy 5,000 contracts to get you $150. So don't take stops personally. Now, we have discussed stops in the last session, but I just want to go over a couple of examples before we close out. So the first example is where we have multiple hits at a range high. Okay? So let's consider stops now in the sense of building a location where traders are willing to buy at high prices. So in this case, as we hit each of these highs, we build up more buy stops above. Okay, so we have a high that gets hit 4 times. At each hit, there's going to be more people going short. And there's going to be early birds that got in here and the latecomers here. From left to right, you're going to have more stops gathering as you go along. In effect, you're building up more buy orders above that high and more energy for an eventual pop through the stops. Okay? And that's why when we talked about fading ranges off the profile, we said, you want to be taking the second, the third hit at the range. You don't want to be fading the 7th hit of a range because there's all these guys up here that are saying, yeah, I'll buy from you if the price comes up here. And if you're a seller, you're thinking, well, yeah, I'll sell to you at those prices. Okay? So the longer you fade the range, the more likely we're going to take a look up into these prices, but it doesn't mean that we'll carry on up. Okay? Now, stops aren't always building horizontally. So we often get these cascades. This is something that's going to happen a lot when you go into the Globex and you get into the pit session on the indices. You have a market that's gradually rising with higher highs and higher lows, or lower falling with lower highs and lower lows. You'll obviously have stops either side, okay? But if you look below, what I've drawn is this kind of funnel shape where each hit to the low, we actually build up more stops below, okay? So don't think of stops as just being horizontal. We can see here that we build stops kind of up below in a channel. So as the market drops below this 0.8, we hit the stops below 0.8. That causes us to push down through the stops below 0.6. That causes us to hit through the stops below 0.4. So that is a stop cascade. Now, this example isn't off the open, but it's worth keeping in mind off the open. If you've got a market like the ES, we have a Globex and a Globex session and open. The stops can push the market low enough to trigger the other stops, especially when there isn't much gap between the lows. So whether you trade into these stops is up to you, but you have to be aware that when a cascade is below you, because if you're leaning on this 0.8 to take a long, so if you're saying, yeah, this is a pullback, you might be saying this is a pullback because of the size of the move. So you've decided, yeah, that's a measured move. I can see the absorption on here, okay? What's going to happen in terms of order flow when you go through that point, okay? You know there's actually going to be more order flow, more sell market orders coming into the market below this point. So if you're leaning on this 0.8, you're not going to have time to finesse an exit when it comes down. This is a case where you will have to stop out of a hard stop if you get into that trade at all. So I just wanted to kind of cover the way I consider stops in terms of, like, there's a bunch of guys here that want to sell at low prices because that's what it is, and people will take advantage of that. But be aware of where those areas are building, because that's going to bring in additional order flow. And if you are leaning on order flow, you want to try and be aware of, yeah, sure, there's a price here where they're holding the level. There's a price maybe just below this 0.8. The bidders are absorbing. It's great to be aware of that. It's great to lean on that. But guess what? What's going to happen if that level breaks? Is there any additional order flow that's going to come in if that happens? And absolutely yes. So that gives you a bit of extra risk on that trade. So we're almost at the close. I can see we've had some questions, and we are going to do some questions now. So poor old Eddie, I don't know if he's kept up with the questions at all, but you can start typing them in now. You okay, Eddie?
Okay. Ready to go. I've been following along here. We do have a lot of questions.
Yep. I tell you, let's give them time to type them in, and then I'll just go through this slide, and then we can start the questions.
Okay, sure. All right.
Okay.
Just real quick, we're typing. If you do have questions and you're our guest, we're in the lounge, and this is where we are taking the questions. So if you need to find the lounge, click on the TST logo on the lower left of your chat screen, and you'll see the Trading Pits tab come in, and you can join us in the lounge. So if you do have questions, by all means, Peter, I believe you're ready, right?
Okay, so we look at negative impact. Everything we talked about really today is avoiding negative impact and logging as well. Order flow is going to benefit your trading, obviously, if you're logging it and you're actually tracking what's working for you. But it's going to keep you out of some good trades too. So don't be surprised at that. And it's the overall benefit that you're looking for, the overall impact. If you do use order flow, I would advise not taking a trade for the first 5 or 10 minutes from the time you sit at your desk, because every day is a little bit different, and the liquidity is different, the number of trades at each price is different, the way it ticks up and ticks down is different. Not so different that you have to relearn every day, but just some subtle differences. You need a tuning in period when you sit down. So if you just sit down and 2 minutes later you see absorption on the bid, 2,000 contracts, and you go long, before that you sat down, that might have been the norm. You might have been seeing 2,000 tick down, 2,000 tick down, 2,000 tick down. But because you're not really tuned into the market, you're not really aware, you don't have that awareness of what's going on. So don't just sit down and trade it. That is a big killer, a big thing that got me into trouble with order flow. At first, it's going to seem like hard work. But after a while, you're going to wonder how you really ever watch a price chart, because a price chart's got really not a lot going on. So to me, watching a price chart's like watching paint dry. Now, the downside of the additional activity with order flow is there's always something going on, is the tendency to jump at shadows because of all the movement. And that's one of the reasons I say it's really important to log your off-plan trades, so trades that don't conform to your plan, because it's a big thing with order flow traders. You're seeing stuff all the time. And the other thing is, the good opportunities, the best opportunities, are usually fairly obvious. So if you're not selective, and again, this is personal experience, if you're not selective in the opportunities you take, you're going to find yourself in a lot of crappy short trades when the long of the day pops up. So be selective, and again, if you have the plan, it'll allow you to be selective. Now, you've got to acknowledge when the range is too small to trade because of retail commissions. They are proportionally large on small trades. So some of the short-term setups we've discussed in the webinars, especially the day trading without charts, are not worth taking if it's only going to pay a couple of ticks and your risk is also a couple of ticks. So sometimes you're going to have the opportunities. They're going to be there. They're going to be real, but your commission structure just isn't going to allow you to take them. Okay. And finally, the one thing that is kind of tough for the guys who are going to trade short term is you have to be pretty merciless on cutting trades, especially if you're a short term trader. So if you can't take the loss when you need to, especially in short term trading, you're going to have single losing trades that are literally going to wipe out days or even weeks of profits. Because knowing when a trade's against you is kind of one thing, but hitting the exit button when you know that trade is going against you, it really is a different skill. So if you're going to get into the short-term trading, but you're one of these guys that says, okay, I'll give it a bit more room, that will basically stop you. That will prevent you from being successful. So we're done on the webinar now. So I'd like to go over to Eddie for questions.
All right, Peter, very well done. And I surely hope that everybody listening was taking notes. So I hope so. They had their journals out. All right, we're going to start out with questions here. And Beamish had a question. I know he was asking me earlier. Beamish says, question for Peter, does your principles apply to crude as well as just S&P minis?
Yeah, with crude, general rule of thumb, thinner markets, people tend to focus more on the tape than the dome. Although I do know a full-time trader that trades crude off the dome, which I think is quite insane. Different strokes for different folks. What I'll say is with crude, you have to look over activity over a series of prices, whereas with thicker markets like ES and US Treasuries, you're looking at a single price. But absolutely, I talk about the ES primarily because it's what I trade. If I tried to trade crude oil, I'd get my ass handed to me. Basically, I don't, no shame in that. So I'm a thick market guy, so that's what I focus on.
All right. Thank you, BB, and thank you, Peter. Ajax has a question. From what I remember, the CME changed the time and sales information on the ES.
Yes.
That's in the last few years to make it less transparent. You've heard about this. If so, how does this affect your approach?
I don't think they did it to make it less transparent. I think they did it because the nerds felt it was more accurate. So basically, if you put in a market order for 100, and it gets filled against 100 one-lot orders, you see 100 prints. Whereas before they made those changes, if you put a market order in for 100, you saw 100. So that was when I was learning order flow. I was learning order flow at that point. And it was almost an aside. The guy teaching me said, but of course, the CME changed the time and sell, so you can't see all that stuff anymore. I'm like, what? And that is the only reason I ended up getting involved in jigsaw trading and writing the tools. So the tools you're looking at now are actually something called reconstructed tape. And these tools actually put together the trades. So on these tools, when somebody puts in a 100-lot order, you see 100. But absolutely, it is. If you're using time and sales, you need some form of trade consolidation. I think Jigsaw's is best, but other people also do this kind of thing. But yeah, absolutely agree. I think it was nerds more than the CME being, make it trying to hide stuff. But yeah, I do agree. It did make it difficult.
All right. Yes, they tend to like to do that. I heard rumor has it that they're going to be changing the boards to Roman numerals. So get up on your Roman numerals. What's it trading? I don't know. V1 I don't know. Okay. Next question. Beamish again. Question for Peter. Do you change your stance while in a trade, or do you pick your risk levels, or just stick with those levels the entire trade? If it works, then it works. If you get stopped, then you get stopped.
The way I work is I do something that a lot of people hate, which is scaling out. And I've heard people say, man, I can prove to you mathematically that the way you trade will lose your money, or that scaling out makes less money, but I think it's partly a comfort thing. But I scale out. So what I do is I take some profit at 4 ticks, and so I manage the first part of my trade almost like I'm scalping. So I'll close that trade out. If I can't get the 4 ticks, if I go to 4 ticks and I don't get filled, and I come back to my entry price, I'll get rid of the trade because I don't like to see it get to my 4 ticks. So basically, at the start of the trade, yes, absolutely, I'll be brutal with the trade and chop and cut it out. Once it's gone through that first target, I'll let it run. And I'll kind of I'll kind of ignore the order flow a bit more. So for me, that kind of focus on order flow after entering is just till I get my first target, and after that, I absolutely just let it run, because I do find that if you're micromanaging the order flow for the whole trade, you will just keep stopping yourself out.
Okay. Next question is, hey, Beamish again. Question for Peter. Crude often moves towards size. Do you use that information as an indication of where pivots might occur?
Not personally. I mean, I've heard this thing that the markets always move towards size, but if the markets always did something, we just can trade that and forget everything else. So when I see size and I watch market trade towards it, I'm looking for, okay, what does that size do? Does it move up? If the size is on the offer and the market moves towards it, does it move up out of the way? Or, as I start trading into it, does it just get pulled? So it's really how that size reacts to trading towards it that I take into account, not so much just the size itself.
All right, thanks, Peter. IJK has a question. Even though I can identify with not committing to trade plans and execution strategies, I have yet to find people who trade live and make money who talk about their cake. Any thoughts on where to go to find cake? And also, does your software do anything to help traders defend against algo runs?
Where to find cake? I think value. There are people out there that do. There's L2ST, there's JPJ Trading, there's a lot of people that do market profile type stuff. And really, the kind of market profile, they kind of look like funky charts. But if you look at my pre-market prep on TopStep, that's one way to do the cake. But effectively, I think the best things that I've seen are value-based concepts. And if you look at the value-based stuff, I think those things are valid. But you can have a look at my pre-market prep every day. That'll give you a good idea of what the levels that I look for. And as for algos, basically I'm looking for absorption. I think to some extent people can see HFTs as the big boogeyman, but I don't do anything to say, oh my God, the HFTs, the bots are out to get me, I better do something against that. If I see order flow against me, I get out basically, but no, I don't do anything to defend against that. I don't think I need to.
All right, thank you on that. Fred has a question here. Question for Peter. How does the time of day affect your order flow outlook? Do you trade at the open, for example?
I have done. I mean, yeah, I have done. I don't so much now. I mean, sometimes the best time to trade is 15 minutes after the open. And then sometimes it's not because you've got news at 10 o'clock. Sometimes there's great order flow setups right at the open. So if you've had a lot of volume build up over the Globex session, so you've got like 6 prices in Globex where there's a ton of volume, sometimes it'll open up near there and the outside of that will hold. But you've got to be really quick. So yeah, I have traded the open before. I tend to wait 15 minutes in, let the volume profile build up a little bit and then trade off that. So, 15 minutes in, and then usually by the time 11:30 comes round, I'm not really looking for any more trades. And then I don't trade the afternoons. Yeah. Eddie?
Okay. All right. Taking a look here, I think that might be it. If you do have any questions, we still have a few minutes here if you'd like to ask Peter. There's a question here right now. TDT has a question. Question, I see problems. You can't see trend. You can get stopped on a pullback. Target can see a 5-point target. You're bumping heads with algorithms, unless I'm wrong. Thoughts on that?
Yeah, absolutely. All of those are true, but obviously this is part of being trading. Trading's a skill, and the skill is to know when you're getting stopped out, knowing when the flow's against you, knowing when you've got to a point where the market's going to go any further. It's all possible. It's all possible. But you can see a trend. You can see a trend. I mean, if you look at the first webinar we did on Top Step, we absolutely put some meat on the bone. And how's there a trend? The overall delta in a thick market will tell you which way the market's trending. Absolutely. You can get stopped on a pullback. Absolutely, you can get stopped on a pullback. But all trades you can get stopped at. You can't say, I'm going to take pullbacks, they're all going to be winners. Nobody's saying that. You can't see a 5-point target. Well, that's true. You can't see a 5-point target, but I scale out. First scale's 4 ticks and then 4 to 6 usually after that. So I don't rely on seeing a specific target. I get up and away. And the algorithms, honestly, I think the big thing about HFTs and algorithms, I think a lot of it is people using it as an excuse for getting stopped out. It's just a market at the end of the day. It's just a market at the end of the day. You can see turning points. You can see the flow, whether the flow's on your side or not. But yeah, there are problems. There are problems. There's always problems with trading.
Okay. Question from IJK here. Where does Peter's daily plan show up? What I'm going to do is I'm going to post one of the posts that I have. I know Peter posts it in the equities room.
Yep.
This is what the post looks like. If you want to take a look at today's, you can. I usually post that in the lounge, the room that we're in right now, and also in the Squawk Radio as soon as it's available on the blog. So when you do see that, just click on that. That'll get you to the blog. Otherwise, we have the pleasure of having Peter in the equities room very early, talking with the traders and sharing that blog also.
I see another question there, Eddie.
Yes, we've got here. CAC has a question. Peter, what criteria do you use to decide after being stopped out to re-enter with your original position, or flip it, or go in the opposite direction based on order flow?
Okay, that kind of depends on the type of day, but basically the flip it and go in the opposite direction on most days on the ES is not something I'd ever do, because I actually have a way to set my bias. So basically the way I trade is I'm going to set my bias, and we talked about this in the first webinar. I set my bias, and if my bias is long, I will only look for long trades. And then re-entering in my original position, well, I will, if I get stopped out on a long trade when my bias is long, I won't get in long at the same position. I'll kind of sit back and just watch to see what happens, because usually if I'm long, it's against an area in the volume profile. And then when we come back at it, if it does that area in the volume profile doesn't hold, then I'm going to sit back and reassess and see where the volume builds and see what happens. So I just sit back. I just kind of take a step back, but I would never flip a position.
All right, thank you. Thank you, Kek. Thank you, Peter. Rusty has a question. Peter, have you evaluated volume spread analysis, VSA, from a cake standpoint?
Yeah, good question, actually, Rusty. In fact, I have. I read. I actually saw a series of webinars on VSA, and what I came away with. So I'm not an expert in it. I never tried to apply it. It seemed like some really good concepts, but it also seemed like they tried to make it very complex and kind of force it into a course. So I think with VSA, you could probably boil it down to like 4 or 5 simple concepts, but that wouldn't have sold a 300-hour video course. So I absolutely do think there's probably things you can take away from VSA and implement. But all this stuff about, if the third bar back is bigger than the fourth bar before it, and it's a Sunday and it's cloudy outside, and the volume on the third bar is half of what the fifth bar volume is, all that stuff, I just think I don't buy it. I don't buy that it has to be that complicated. But the actual, the theory behind it, VSA, I thought it was, I think it's valid.
All right. Thank you, Peter. And thank you, Rusty. Good question. All right. So, Peter, I think that is it with the questions. And I did post. You got more? Did you find some more?
No. I'm just cheering.
What's your favorite color? What's your quest? And by the way, what's your name? All right. I did post more information for Peter's website. It's www.jigsawtrading.com. We do have Peter here every Tuesday and Thursday, and lucky to have him in the equities room every day. So if you do have any questions, I mean, we've got the website there, but if you do lose that website, bookmark it. You can always contact us. We'll get you in contact with Peter Davies and the fantastic Jigsaw Trading Company. But Peter, appreciate it. I know it's very late where you are right now, and
It's Miller time.
you guys get Miller out there? Or
No, heavens no. That's a good thing. One of the benefits of being in Thailand.
There you go. All right, we'll get a flat tire for you. 12 flat tire coming your way.
It's a fat tire, Eddie, not a flat tire.
No, but I'm keeping the fat
Okay.
tire. I'm gonna say flat tire. Some guy on a bike with flat tires and some Miller. All right. But Peter, appreciate it very much here, and it's always good to have you on, especially with our featured speaker of the week. So the highlight, the cherry on top of the sundae. Peter, you have a great weekend. Get some rest,
Okay.
and we'll call you back on Tuesday, huh?
Yeah, I'll see you on Tuesday, Eddie. And thanks everyone for listening. I do appreciate it. And I'll speak to you next week.
All right. Thanks, Peter.
All right,
Take care.
Cheers. Bye.